Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking about the £800 gorilla on the stock market in the telecommunications space, and it's Telstra, ASX code TLS. G'day, Elio.
Yeah, g'day, Phil. I thought we would talk about a stock that no doubt everyone's got an opinion on. They've been watching it for quite a while and it really hasn't done much. So I suppose we might as well, run over it again, as it were, and just really kick the tyres on this one to see whether it's appropriate for someone at the moment. And let's face it, it's better buying today than it was a year ago. So it could be the right time to look at it.
And its all-time high was in 2015, I believe. And if you look at the chart, it's not one of those charts we like to look at. It's top left to bottom right.
Yeah, exactly. You don't need a degree to figure that one out. And look, it's a bit of a storied history, of course. T1, which started back in 97, actually, for those old enough to actually remember that. Then you had T2, and that was good. And then, of course, T3 was the big heavy hitter. Everyone piled in, and they got absolutely smacked. And that was around 2006. And, of course, it's a massive history in regards to, is the dividend worth it? Are they paying dividends through debt? You had crazy Mexicans. You've basically had anyone and everyone have their view in regards to Telstra. But, of course, a period of stability did come when Andy Penn assumed the role way back when. And now that's been passed on to Vicky Brady, of course. But unfortunately, a leopard doesn't change the spots in many people's opinions. So, but then again, I think it's too soon to throw this out with the bathwater at the moment, or this baby out with the bathwater, as it were. But suffice to say, there are obvious challenges. And I think the numbers do show those, Phil.
So just looking at the numbers, why is it in the super stock bucket on Stockopedia?
Oh, look, it's interesting because basically we've got to remember that, yes, whilst momentum is an element of the overall three scores, as it were, we also have the ranks of a business with regards to how we look at the company. And most of that is assessed by the fundamentals, as it were, both the growth metrics and the value metrics. So, yes, you've got to basically insert a line somewhere. Is it the strongest of the super stocks? Probably not. I think it's fair to say, but I don't think it's necessarily fair to call it a high flyer either, given the fact that the share price has been going down. And I don't think its fundamental performance is bad enough to call it a contrarian or turnaround type of stock. So in our view, or has been bad enough to be considered those things. So yes, it is ranked as a super stock at the moment, but it doesn't take much to just scratch below the surface in order to look at the business. And I alluded to that in that introduction, that this is not a basket case. And it's not. I mean, to be fair, we have a no admin portfolio server or system, as it were, that we run at the start of the year. And telco being a very small sector, there aren't many in that space that are actually as fundamentally strong as what a Telstra is. And every time you drive by a bus stop, Phil, you'll notice everyone's looking at their phones and doing all that stuff. So you exclude a business like Telstra at your own peril. Then again, when you look at the performance metrics, as it were, one could argue that it should be better or doing better than what it actually is, given the fact that it has such a captive audience. And I think looking at the numbers does help explain that somewhat. But yeah, not a basket case, but I think it just should be doing better.
So it recently made the news because it cut nearly 3,000 staff. Some have looked at this and said that this is just a play to improve the bottom line. And it is sad for people that have been laid off, obviously. But is this going to have a material impact on the bottom line?
Oh, look, I wish. Okay, so a bit of a history lesson for everyone. But I don't want to bore everyone to snores in regards to Telstra because, of course, it's multi-layered and very deep in order to understand it. But back in the day when they released their T22 strategy, that was designed, of course, to improve margins and effectively turn this business from what was not as sharp. I mean, it was definitely sharper than what it was back in the telecom days. Oh, geez, I had two uncles that actually work for Telecom, and let me tell you, two of the laziest blokes you've ever seen on the planet. But anyway,
and their union was pretty good as well. The Telecom union, one of the strongest unions.
Anyway, look, obviously they wanted to, make their business more efficient. They wanted to introduce clear, distinct, as it were, call it pillars or funnels or call it what you like to the business that obviously could be more easily packed up and sold if needed, even though they had a false start in regards to the InfraCo business not that long ago. But anyway, they went through a whole lot of pain. Now, T22 then became extended to T25. And that obviously, again, when you read the literature in regards to that, making it a great place to work, improving our margins, blah, 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 pretty much, standard 101 type of management commentary, to be honest, notwithstanding that this is a very complex business too. Now, I think where investors were disappointed, as disappointing as the job cuts were, is not necessarily that they would have to make job cuts. Quite frankly, if you're a mega business the size of Telstra, you're always going to be in the eye managing PR as well as you are managing company activities, and therefore that's a challenge. But where I think investors were really disappointed is that in this lead up to this most recent update, you constantly heard, we're fine, we're fine, we're fine, we're fine, we're not fine. And that really came as a bit of a shock, not so much to the trend watchers, because of course they were seeing a downward movement in price and therefore had been gleefully ignoring this one, as it were. But when you're a fundamental investor, and if you're backing the story, backing management, backing Vicky, who now runs the entity, and you're constantly being told that we're on track, we're on track, we're on track, we're on track, now we're not on track. And it's like, well, okay, hang on a tick. Where's that disconnect come from? How could you go from we're on path to not on path? And I think investors have been spooked by that, because that's not something you normally get from a mega company like this. I mean, Telstra's not going to shoot the lights out. I mean, they're biggest in the tree. I think there's something like the 16th largest stock on the stock exchange. So you're not necessarily going to get dynamic growth from them. In fact, in that quarterly or that update that you were referring to there, Phil.
That's an understatement, Elliot.
Yeah,
you're not going to get dynamic growth.
No, well, okay. I'm a big fan of understatements, as you know, Phil, so I might as well add that one there to that. But with regards to, they did reaffirm their guidance in regards to their earnings target, and they've constantly said they expect single-digit earnings growth. So they're not necessarily shooting the lights out, and they've constantly, but you've accepted that as an investor in this business. You even accepted at the time of the half-year report where the dividends per share were higher than the earnings per share, and I'm sure this would have raised the ire and the concern of investors in the past who are remembering the dark old days of Telstra and what it used to do and how that dividend was managed and how that was sustained or ultimately not sustainable. So that was an initial warning bell, and we saw weakness in regards to price since then. And then, of course, has been this most recent update, which, like I said, it does just smell very different than what we've been hearing from the company in recent times. So notwithstanding that it's been doing quite a few good things, let's face it, it's a hard business to run, Telstra. It ain't easy, but nonetheless, it's still done operationally okay. It's just a shame, for love of money, they can't find anyone that backs them or anyone significant enough to back them. And even though they've gone through the process of divesting their business into these separate pillars, unfortunately, they still don't have the love and support from the market that has come in and seen that very broad support for it, as it were, and its share price is pretty much reflecting that.
Are you picking shares on gut instinct, buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So one part of this sprawling enterprise is the Fixed Enterprise Business Unit, which reported a 66.7% drop in EBITDA in February. What is this part of the business, the Telstra Fixed Enterprise Business Unit?
Yeah, just as very difficult going down a road, Warren, in regards to understanding the individual divisions and departments of a business like Telstra. But I think that further reaffirms another thing that was occurring with the business. There were clear, distinct channels in regards to the business. You had InfraCo, you got ServiceCo. The third one escapes me at the moment, but the whole idea of structuring that and all run under the Telstra Group. And the whole purpose of that was that ultimately you could possibly kick the tires on one of the divisions and possibly, take them over if you needed to. But as time has gone on now, we're starting to see less and less reference to these, big pillars, as it were, these terms. In fact, I think InfraCo, they were looking to offload a non-controlling interest in regards to that business. InfraCo, just to keep it simple, are the towers and the wires and all that sort of stuff. And they haven't been able to find an attractive enough price for that. Surprise, surprise. And therefore, they're going to keep it and maintain it. So one's got to ask, what was the point of going through all that anyway? But that's by the by. So when you see this, but now we're starting to see divisions broken up into fixed infrastructure, mobile phones, et cetera, et cetera, et cetera. And there's a lot of commentary that is delivered in regards to that, which probably it needs to be in regards to making it more granular for DIY investors to understand what's going on. And again, that fixed line enterprise component is, as the cables, it's why would you necessarily negotiate with NBN and all the challenges and focuses there when you could possibly have a mobile solution whereby that pipes into your business as good enough for what you need it to do and obviously removes that overhang. Yes, we need fibre to the building, as it were, particularly in those big high-rise places, but possibly not in others. And they operate in a competitive environment, notwithstanding that Optus hasn't gone broke after that data breach, but nonetheless, they still need to necessarily be there and they have to go out and they have to sell things. So as much as it pains that, yes, we're all using the internet more every day, and I'm at pains to find anyone that can convince me that over the next 10 years we'll need less of it then than what we do today. So there is an underlying demand with regards to their services. We're going to need more data that comes through the pipe. The emergence of AI, it's all well and good to have a neural network or some sort of system that does all this thing and things like a human, but then you got to pump that data down through a pipe. Notwithstanding, I think they're doing the third NBN rollout or something like that now at the moment, or something akin to that. Our data needs are only going to increase over time. So when you see such a high in demand and service, division take such a hit as they did, that is a bit of a red flag, because it's like, well, hang on a tick. Why are they missing out on all this? And I think investors were, again, to that narrative that I was describing earlier, where everything was fine, not fine. That there is, one of those warning signals, because it really did shake the logic and thinking of a lot of people, notwithstanding the underlying value, but more importantly, the quality that resides in this business.
So speaking of data, it does beg the question is why there hasn't been a strategy to become involved in data centres. I mean, they've got the pipes to send that data around, but data centres seems like a natural home for a telecommunications giant like Telstra.
Yeah, it's been working well for Goodman Group. It's been working well for NextDC. There's a number of others out there. Why wouldn't
Macquarie?
Macquarie Telecom. They might actually be having these discussions, Phil, in their boardrooms. Of course, we're not privy to those, and nor should we be, because it'd be illegal if we were trading based on that. But nonetheless, though, you would assume that it is a natural extension of their business. Of course, their need to continually upgrade and buy spectrum is a massive thing. And that's one of the things with this business, their CapEx expenditure. The company did make light of the fact that in their half-year report that they will be spending a lot less on capital expenditure in this half. I think it was 1.8 billion versus what was 1.8 times, I think, revenue or sales. But anyway, it was definitely a lot less than what it was from the year prior. So that would have been somewhat of a reprieve. Maybe there's some investors hoping for that earnings growth of 13 to 17% that they get, not that long ago, but it was only about 2 or 3 years ago. But obviously, as we all come out of our cave, that's possibly a little harder and a bit of a stretch. And I think even on the generous side, in regards to high single-digit earnings growth, that's now come under challenge due to that downgrade that you were mentioning there. So, look, how they realise the massive value that they have will be interesting. Unfortunately, as with most big monoliths, they're slow moving. So like turning the Titanic, it takes them or seemingly a forever or an age to actually do something that's worthwhile. And then when they try to do something, inevitably it's a bunch of bureaucrats that make the decision, which means they've probably learnt about it too late and it's not necessarily making them any money anyway. So they want to simplify their business. They've got to stay in the realm that they're good at. I really don't want to see them go into areas and streams that they're not necessarily experts at. I want them to stay in that focus. Maybe data centers is included in that. I just don't know. And that may very well be. But I think deploying or where they deploy any future capital will be critical because in regards to the infrastructure, they do already put a hell of a lot into it. And notwithstanding the earnings challenges, I think investors want to know where to next. When you already got dominant market share in Australia, where could you possibly grow from there? And ultimately, the market is about that. It's about identifying growth, even though some like to think it's about income. That was a false dawn. You weren't ever thinking about that. And if you want rates back at emergency levels, our economy will be a lot sicker than where it is today. So it's just not going to happen. It's just investing for false pretenses, investing for income.
So, Elio, let's dive into the numbers. Let's have a deeper look in why you possibly think it may be an attractive opportunity. Is it just about the income?
No, it's not about the income. In fact, the thing that actually makes it attractive from our perspective is the quality score. So the quality score, for those that may not be aware, is where we get to assess the actual numbers of the business. And we look at things like the profit and loss, the balance sheet, and of course the cash flow statement. And we assess how things are going in that perspective. And you're right in the sense that it is able to pay that dividend mainly because it is a cash machine. It's spitting cash and has done so consistently for quite some time. We have a Beanish M score, which is low, which basically reflects the idea that what they do generate in terms of profitability is reflected in the cash flow statement. So that is quite good. Whilst the return on equity at 13% is not something to shoot the lights out about, it's better than its counterparts in the industry or a lot of its counterparts in the industry. And it's obviously better than a kick in the teeth. And I'm still yet to find cash deposit sort of return that can generate that for me. You do touch on the dividend yield, and that's one of the components of what we call the value metric. Now, our value score on Telstra at the moment is 64. Now, this might come as a bit of a shock to a lot of people because obviously the price has fallen over the last 12 months or even longer if you want to go that far back. And the dividend yield is currently 5.2% and is fully franked for the upcoming year. That's an annual yield, by the way, folks, not a half year. Now, of course, that is one thing. But then I touched on the fact that earnings per share at the moment was below what the dividend per share was actually being paid. This is less of a concern when you're a company as strong as Telstra that has been producing as much cash as it has, that it can use its cash resource in order to cover this dividend, and that obviously covers any massive depreciation and any sort of amortization costs that such big infrastructure firms have. So you can't dismiss it, as it were, but it ain't the cheapest, if that makes sense. And I think that might come as a bit of a shock to a lot of investors, that notwithstanding that Telstra has had a very bad run in price, it ain't the cheapest. And then that extends to momentum, which also sits at 65. So it ain't shooting the lights out either. And I hate to state the obvious, but when you look at the price momentum relative to key measures against the market, it's been underperforming the market consistently. Obviously, it hasn't done too well with regards to its price relative to its moving averages. In fact, I think the 50-day, the golden cross or the death cross, whatever people call it, I think that occurred back in October, and that was at around a little over $4, and the stock's 50 cents cheaper than that at the moment. So even if you were using something as rudimentary as that, there's pretty much no reason to be in a Telstra from a momentum perspective, because to be quite frank, when you're rated 65, that means there's 35% of it that's better than you. And when it comes to our ASX investing market, we're talking about 700 to 800 businesses that are better from a momentum perspective. So, the lament that many punters have in continuing to hold something like a Telstra, if they're using charts or they're looking at squiggly lines, then there's really no reason why they should be upset, because the numbers were there and available for them. But of course, there will be some true believers because of all those reasons I talked about earlier, that we're going to need their services. They're going to have to expand. And when you look at things like the Piotrowski F-score, it gets 8 out of 9 in regards to that. Notwithstanding the debt that it does raise, that cash flow covers that and is able to consistently pay that back. And its operating margin, by no means disastrous as well, at around 13%. And a lot of that is part of that service co business, the actual mobile sort of stuff, because the infrastructure items aren't necessarily as generous, as it were, in regards to margins and the like. And then they look at forecasts, and all those forecasts continue to trend up. So I can see why people will retain the faith, because quite frankly, I can't see less of a need for it. As I alluded to a little earlier, a leopard doesn't change its spots. So you're going to have to really get some intel in regards to why this is going to operate different to what the market is necessarily perceiving it at the moment. Because let's face it, there's a lot of learned people looking at this stock at the moment. I think there's something like 16 brokers at the moment that are looking at this business. And over the last 3 months, they have been reducing their earnings per share expectation in this company, which, again, from a momentum perspective, it's not necessarily great, but you've got to be able to read the tea leaves. And notwithstanding what the absolute number might be and how that might look attractive, the trend in that doesn't look great either. But if you're taking a long-term view, if you want to bank that dividend, then I'm stating the obvious that it's better buying now than what it was a year ago. But then again, if you are focused on price appreciation and capital appreciation, or a total return, as it were, which is obviously both price increasing and the dividend as well, there may be opportunities elsewhere. And you sort of have to ignore the fact that it is a big quality stock that is spitting cash. And you sort of just got to say, put it in the too hard basket and say, yep, that's great. But you know what? When you're growing dividends at a CAGR over 5 years of, say, 2.3%, that's cash over 2.3%, but dividends 2.5%, then you know what? Does that necessarily float your boat? I don't know. It might not. It's the difference between assessing a business from a relative perspective versus assessing them from an absolute perspective. It's one of the reasons why I definitely look at things, relative. So it's not just about, should I invest in this stock? It's, should I invest in this stock relative to what? And at the moment, notwithstanding its quality, I'm going to give this a wide berth.
So, Elio, tell us about the Stockopedia end of financial year sale that you've got running at the moment.
Yeah, look, if you're a DIY investor and you like to look at the numbers yourself and kick the tires, as it were, in regards to companies, then yes, we do have end of financial year sale. There's a range of levels of saving that you could possibly achieve relative to which package you get, because, of course, we cover the entire global market. And we'll also throw in a free copy of Roger Montgomery's Valuable. He will be appearing to our members and to guests as well in a webinar where we'll be talking about his investment approach and his style in regards to assessing businesses. Just in the interest of learning, in the interest of sharing, we want to do that. So it doesn't come around very often. If you've got a good accountant, chances are it'll be tax deductible. There is obviously all that income and dividend information in there that you need, plus all the raft of other data that you need. And one of the great things I love about data, Phil, is that, CEOs will lie. They always do. They're glorified marketers. We know that, right? So CEOs will lie, but the numbers won't. So when it comes to assessing the actual numbers of a business and then assessing one company against another, then that's where a tool like Stockopedia really comes to the fore. So if you want a cabinet, you can go to the shop and buy yourself a cabinet. But I'll tell you what, if you want a really good hammer, then you need to come to something like Stockopedia. And right now, at the end of the financial year, is a great time to consider as well.
And we've got the links in the episode notes as well, accompanying this episode. Elio D'Amato, thank you very much for joining me today.
Yeah, thanks very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.